Hello, and thanks for joining us today. I'm really excited you could be here because today we're talking about my favorite topic, which is money and how to get a lot more of it for your business, especially if you're in e-commerce. So with us today is Eric Youngstrom. Now, Eric is a startup executive with a proven record of success exceeding business goals in multinational and startup technology companies, and a leader in early stage software startups as well that have since generated more than 400 million in shareholder returns through successful exits. Now, he has proven the ability to conceive and build revenue generating businesses from the ground up across the consumer, SMB, and enterprise markets. He has expertise in each aspect of the product lifecycle, from strategic direction, product concept and development, marketing, business development, and operational implementation. Now, he's demonstrated success in building creative solutions and developing teams to penetrate new markets that transform P&L results as well. Eric, thanks for joining us here today.
Thank you for having me. I appreciate it.
Yeah. So what are you up to right now? I see that, in my world, we help business owners get capital. So that's always something I'm really excited about. And it seems like you guys are doing some pretty cool stuff for e-commerce businesses.
I think we are. Yeah, we're offering working capital financing solutions really designed to solve the e-commerce cash conversion cycle problem. So really just, how do we help merchants where they've gotten an early stage business off the ground, they're generating real revenue, and yet really the profit from that revenue on an accounting standpoint, right, looks fantastic. They're, generating 10, 20% profit margins. But because of the turnover cycle of inventory and the sales turnover cycle, really the profit is captured in there, right, in that slow cash conversion cycle. And so what we're offering merchants is an opportunity to replace their money trapped in that cycle with our money, so they can redeploy their funds into higher growth activities and really treat those as more investment funds versus turnover funds.
Real problem you talk about here, and it's gotten worse, it seems like, with supply chain issues. So what are you seeing from the ground? What are you seeing the supply issues has done to this cycle?
It's certainly lengthened it, right? It really depends on where your supply chain is, right? If you're a Chinese-based supply chain, which many merchants are, you've got longer cycle times with cities getting shut down with COVID over there. It certainly delays things getting in. Last year and even this year, right, we're seeing a lot of problems with the West Coast ports and how long it takes to get a container ship into the port and unloaded. And so we've actually helped a lot of our merchants, not just with capital, but with advisory services where, given my background in, supply chain and the D2C shipping world at Shipping Easy prior to OnRamp, we have just a lot of exposure to, how do you optimize the supply chain? So we've spent time helping our merchants really optimize to get, ocean-borne cargo going through Houston, going through Florida, where the ports were open. And so that, you could receive your inventory. You didn't have that 90-day float time in Long Beach Harbor where you were waiting for everything to just the congestion to get worked out. So, really, we see everything in the U.S. supply chain moving pretty quickly. You do have to watch out for, your raw goods if there are materials stuck in China that your suppliers are using. But on the U.S. side, we've seen a pretty tight ship. On the global side, it's just been slower with port congestion.
So I'm interested, what else are you seeing be done to correct that problem? Because what you said is brilliant there of kind of redirecting to come to ports that are open. But that's the exact problem you solve, is this cycle where they don't have enough money coming in. I mean, right, because they're selling inventory, they got to buy the inventory. There's a lag between when they get the inventory or pay for it, and they can actually sell it and make money. And I would imagine that's substantially increased with what you're describing. So what else are you kind of seeing that e-commerce entrepreneurs especially are doing to solve those problems right now?
Well, certainly, we see the entrepreneurs are ordering more inventory, right? One, trying to take advantage of additional bulk discounts, which is really smart. That still has to be framed within the concept of how quickly it's going to turn over, right? Especially for people selling perishable products. Also, just looking at different suppliers, right? Are there countries they can go buy from? Are there opportunities to purchase inventory direct in the U.S.? That certainly comes with different costs, but the dollar cost increase may be more than offset by the time value savings, right? Because you're not waiting for stuff to get out of China. You're not waiting for that ocean freight to get through. You're not stuck in Long Beach Harbor. So I think, there are a lot of different approaches and techniques that can be used, right? But they all come with various trade-offs and compromises that have to be measured and then paid for.
The other thing it sounds like you guys are solving right now is the problem with costs going up. I mean, not only do we have inflation, but what you just described of kind of rerouting even vessels to be able to get to places where they don't have long wait, I would imagine that adds additional cost. And again, that makes exasperates the problem that you guys are there to solve. So how are you seeing that affect your merchants now?
Well, the nice thing about ocean freight or waterborne freight, if you will, is the cost is incredibly low, and so the cost there is the time cost of it takes longer to get through the Panama Canal over to Houston or Florida, but the dollar cost of that is pretty negligible on a per unit sold basis. You do have to wait, but you're still moving faster than waiting, in the time that the boats right now are just kind of beach harbor. Clearly, if you're going to go buy from a U.S. supplier, you're probably going to have higher costs there, but now you have a much shortened supply chain time, right? So if you're buying here in the U.S., you might be looking at 2 weeks to get inventory in stock. Buying from China, you might be looking at 6 to 8 weeks. And so the time value of money there, right, just becomes, there's a fair trade-off to that. And if it means you're not running out of stock, right, that's really important as well, because what you don't want is an out of stock sign on your website, right, or on Amazon, where you're going to start losing your product ranking and losing future sales.
So a lot of them are ordering earlier and ordering more, but in doing so, that actually costs more money. So at OnRamp, what do you guys do? I'm interested. Like, what's the solution to that problem? Because the problem we're describing is somebody needs to sell stuff online, right? And then they've got to buy that stuff. And there's a lag between when they spend the money and buy that stuff and they actually get it and sell it. And now that problem is exasperated. The cost to get the stuff is higher. The time it takes in some cases is longer as well. So what do you guys do to solve that problem?
So we look at it as an accounting problem. When you purchase inventory, right, you convert cash, which is an asset, into inventory, which is an asset. And what we're simply doing is saying, hey, use our cash. And so that you'll have the inventory on the books. And then as you sell a unit of inventory, right, we've determined what portion of that sale is owed to OnRamp to pay down that loan. And what we do then is time the collection of that with the deposit of that sales receipt, so that we're fully aligned with the merchant success. If sales accelerate, we'll receive our funds back faster, and we'll have money to give back to the merchant sooner. If their sales decelerate, well, they're going to pay us slower. And then when that loan gets far enough down and they need more money, we're there for them again. But what we're not trying to do is go set up a payment flow that doesn't reflect the actual realities of the day-to-day business and the ebb and flow of the day-to-day business of an e-commerce seller. So, for instance, right now, Christmas is coming up. So, we're actually deploying more funds because we know, for those sellers that actually get that seasonal Christmas lift, they need to have the inventory in stock ready to go. And if you run out in early November, you're probably not going to get more in stock in time to close out the Christmas season. For those merchants who sell seeds and gardening implements, right, we actually won't see that lift until February, March, April. And so we're kind of delaying what they need today because it's just the demand's not there yet. So what we really do is build a product that helps the merchant based on their actual sales performance, their seasonal indexing, and what's going on in the broader market, and then aligns with them and how they pay that back, so that, what we're not trying to do is put the screws to them, right? We really want to be 100% aligned with their sales performance and success, and then just be their long-term working capital partner, continually turning that over to match that inventory turnover cycle.
So I'm selling stuff online. I need to buy inventory. I can come to you to get the money that I need to buy that inventory. And then it sounds like what you're saying is that then I'm paying you back as I'm making sales.
That's right. Yeah. So, the way we think of it is, then if you use our money, right, to get that inventory asset on your books, then when you have that cost of goods sold from a per unit of inventory sold moment in time, right, when that sale happens, when that deposit arrives, then you pay us for that unit of inventory. So really then, from a merchant perspective, they're paying for sales when those sales occur versus prepaying for those sales by buying that inventory in advance and then waiting for that revenue to come in, right? And if you think about that 90-day cycle, it's day 65 to 75 before the first profit dollars from selling that inventory are arriving. But by that point in time, right, if you have a 30-day replenishment cycle, well, you're actually deploying more money at day 60 before any profits come in, which means you're always perpetually just catching up. With us, your cash, that entrepreneur's personal money, has been pulled out of that cycle so they can redeploy it in other channels, opening up new products, right? Selling on new channels, spending more on advertising. And then we pay for that inventory for them. And then as it sells, they just pay that down and then rinse and repeat.
Right. Which is, and I talk about this often, this is what the biggest companies do, right? It's exactly, we're describing what Walmart does. I mean, they use credit to buy the stuff it puts on their shelf, and then they sell the stuff, and they use the money from selling the stuff to pay off credit. I mean, this is how every one of the largest publicly and privately owned companies operates. You're just giving that opportunity to small businesses.
Correct. And what we think we've built, right, is a model and software that helps instill that model, where a merchant who today is not yet big enough to hire a VP of finance or a CFO or a finance team that would go to a bank, negotiate for those terms, but then has to manage that turnover with the bank, right? The banks don't automate this. They say, here's your cash, you've got some payment terms. But if you really want to optimize those things, you have to have a team managing that on a day-to-day basis. What we are is that team for the broad, for the million plus SMB sellers in the US today, that just aren't at a scale yet where they can afford to hire that team. Now, what we do see is somewhere between $5 and $25 million in revenue. Those businesses, right, the revenue size itself forces sophistication upon them, where they're going to hire that CFO. And that person then is going to go to a bank, get better terms than we can offer. And we view that as helping them graduate. What we've done is really instilled that financial discipline in the early days, help them to demonstrate that they can use capital wisely, turn it over appropriately, so that when that CFO arrives, it's a much faster conversation. And then we celebrate the merchant for graduating from on-ramp and getting to a more sustainable, scalable place in their business cycle.
Yeah, and I love this for a lot of reasons. I talk about what you're describing all the time, is that this is how the big companies work. And the reason small business owners don't have that access is they don't have CFOs, they don't have controllers, they don't have those financial savvy people to be able to do it. And this is where there's this massive gap between small and medium-sized businesses that need that help, and they don't get the help. So to answer me this, why don't they get the help? I mean, you're coming up and solving a real problem because most won't step into the space that you're stepping into, meaning the startups, the ones that are newer, that are smaller in the business side, they're the ones that can't get the help from SBA and from the big banks, et cetera. So why is that? Why is that you guys are coming in to solve a problem, yet so few others won't even help this demographic to be able to solve that same problem?
Well, I think there's a number of reasons, right? Like, most companies like to go after enterprise customers because the revenue per customer is so much higher. We are selling a sophisticated product, and it takes a lot of technology to make what is complicated simple. And that is very, very hard to do. And I think, what the team here at OnRamp has with our shared background building shipping solutions for the e-commerce SMBs over the last decade is a ton of experience in how do you simplify the complicated and build a set of solutions via software that you can then automate and take to a large population of users. And so that's what we're building at OnRamp. I think, in fairness to banks, the challenge with banks is they don't just service e-commerce, right? They're working with restaurant owners, they're working with dry cleaners, they're working with school districts. And so because of that, the expectation is the business owner is going to conform with and comply to banking requirements in terms of how they want to look at data and work with you. Whereas what we've built is an engine where we connect to your online store, we connect to your bank accounts and things like that. And then what we do is all that work. So the merchant spends 3 minutes with OnRamp, they're connected. We then ingest the data. We then go build your P&L. We go build forecasts and understand your sales seasonality and everything else, so that we can come back to you and say, here's the money that we can give you. Here's how we think it should turn over. Let's go then, flexibly work with the merchant to understand exactly what they're using it for, what their specific turnover cycle is, and then deploy that product in a way that really is aligned to their business. And in the bank's defense, right, they don't have those tool sets. They don't have that skill set. But in the long run, I think, banks and other industries are going to look at solutions like ours and say, hey, we need to embed that into our product so that we're just more customer centric. And what we're doing right now is taking advantage of the fact that there's a gap there and filling that gap so that we can provide great tools to the e-commerce industry.
So you're talking a lot about software. Give me some more. And what you're saying is really astonishing. It's not a matter of just giving them money. It's a matter of plugging into every aspect of it. The e-commerce business, what are they selling? How often they sell? What's the seasonality of how they're selling? Bank account, how's that cash flow managed? In a low season, what do they do? Where's the money coming from?
Right.
What do they do when things ramp up around Christmas and it's the busiest time? And then that software, it sounds like, gives a lot of projections that gives them insight of how to better even run the business, manage the cash flow they have. Well, you guys are even coming in and helping solve the problem of giving the money they need during that cycle of them needing inventory and actually selling.
That's exactly it. Yeah, we've built software around that entire problem. And we're continuing to hone that software and refine it to make it faster and easier for our SMB clients to use. And then with that, right, we can better optimize the capital we're deploying, which then means over the next year, over 2 years, right, we'll continue to be able to then bring costs down because we'll get more and more efficient and better and better and better at understanding what the merchants need, how to deploy that money appropriately for shipping and fulfillment expenses versus advertising expenses versus inventory expenses, right? Really aligning around that the cost of goods sold that are captured in that cash conversion cycle, and then optimizing cash for that. We're not an investor, right? We don't want to be an investor. We want the merchant to continue to own the business, but we're a lender. But we're really one that is highly optimized for this one specific problem. And the great thing about that then is we can also help the merchants understand how to go work with equipment financing if they need equipment to run their business, to work with mortgage lenders to go buy a warehouse, because those are other important pieces of capital in the overall capital stack, but they don't interfere with the working capital component that we provide.
And I love that for a lot of different reasons. And one of the things that I'm really curious of is that I see how software solves the problem, and I love what you guys do. And I know there's somebody listening to this right now going, can this work for me? So who can you help? Who can you not help with this solution?
Yeah, we're really optimized for merchants with, let's just say, up to anywhere from 100,000 a year in revenue to 20 million. And then they're going to have grown out of what we do today. Our sweet spot really is kind of that $500,000 to $5 million revenue per year customer. You need to be selling physical goods, right? So we're specifically built for e-commerce merchants selling goods that are going to have to be moved from a warehouse to that consumer. So if you're selling a digital product, you really don't have a cost of goods sold in that model that we're appropriate for. And so, we don't help there. We just want to focus on one thing and be the best we can at it. And then we work with US based merchants. So you have to be in the US. Longer term, I'd love to support merchants around the globe. But from our early stage perspective, right, it's always really, really important to focus on a market and a segment so that you can go get really good at that and own that and then scale from there. And that's where we are right now.
So I'm interested, you mentioned being a lending institution. Where do you get your money? I mean, you could share that if you want or not, if you don't. But what I mean by that is it crowdfunding? Is it private investors? Is it actual banks that you're dealing with? Like, where, if you can, if not, we don't have to dive into that. But I'm just curious, coming into the industry, like, where do you kind of get your sources of money to be able to fund these entrepreneurs?
Yeah. So, on the capital we use to fund the entrepreneurs, we will work with institutional credit providers, right? So there's the world's awash in money, and there's a lot of institutional credit out there that is looking for lending opportunities, and looking for people who can do that at scale. And so, we've sourced a number of partners who help us with that. And then, on our growth side, as we're building out software and whatnot, we've taken a traditional VC approach to raise money that's explicitly used, right, for our investment in our software, in our team, in growing the business component of it, right? So that we have, two separate sources of capital, one that supports on-ramp and one that supports the merchants, that we find is working incredibly well. And then, as our business scales, those credit markets continue to be open for us, and we'll continue to work with a broader range of partners in that side of the business.
Yeah, I love that. So you're kind of bridging that gap between the person that needs money and the person that has it, that wants to lend but doesn't want to lend where it's too risky, et cetera. And you're able to use the tech that you've developed to be able to make those two match. What about cost of money? I know you can't tell me rates because, I know there's so many factors of risk but I deal with merchant cash advances, cash flow financing, which can be 40, 50, 60% interest that people pay, all the way to the low side of capital as well. So how do business owners expect to kind of pay back things? Like, is there a generality of what kind of amount they can expect to pay on the capital they get, or even risk factors that tie in to how much they may pay?
Yeah, I think as a rule of thumb, we're going to, one, we're a fee-based product, right? So we don't charge interest. Our fee is a percentage of top line sales, and the amount of that fee will be determined by what percentage of those top line sales you're borrowing, right? So we look at your next, let's call it 90 days, and let's assume you're going to do $500,000 in 90 days and you need 100,000. So you're taking, essentially 20% of that top line sales, and, the fee should be right around 1%. And so what we're trying to do is help the merchants put this in the context of how you run a business, right? Which is, I know my top line 100%, I know my gross profit, I know my net profit. And what we're doing for the merchants, saying, hey, we think you should be able to borrow 200% of that net profit, or 20% of the top line. And for that, you're going to reduce that net profit from, let's just say it was 15% or 10% to 14 or 9%, right? So it's not the lowest cost capital in the world. The challenge is, these small businesses, because we underwrite the business, not the business owner, they don't have the track record yet to qualify for those lower costs of capital, right? Which is why the banks turn them down. And so what we're doing is really building and price optimizing for them, and then trying to structure that in a way that the merchant can look at it and just kind of on the back of the envelope say, hey, great, this reduction in my net profit means I've actually extracted the profit dollars out of the business so that I can either pay myself, right? And if you think about a merchant with $1 million a year in revenue, and let's just say $100,000 profit that should come out to pay himself, that $1 million is probably costing $150,000 to $200,000 in inventory. And if it takes 65 days for profit to start coming out of that, then the profit in the business is automatically put back into the next inventory purchase, which means the merchant's actually never paying themselves a salary. And so what we're saying is, hey, great, you can now pay yourself that salary because that turnover is very measurable. The risk is calculable, and we can price really fairly for it to help the merchant then really start thinking about capital in a way that helps them scale the business. That doesn't think about it in a way of a credit card and a 30-day term that has no flexibility. That's not going to be a bank who says, hold on, we need 40 or 2 to 4 years of audited financials. We don't collect financials from our merchant because we go to the data source and we build the financial portfolio for the merchant.
A lot to that. I mean, first of all, it's really cheap money considering what you guys do, and cheaper to work with you guys than get it through almost any other source, from credit line to loan to credit card. It sounds like it's cheaper to work with you guys than almost what those type of entrepreneurs are going to get in almost any of the sources, at least that I've seen out there personally. Plus, what I like what you guys do is it's a very specialized purpose. What I tell entrepreneurs a lot of times is, if you have something you need specific funding for, get it. That still leaves you the ability to get credit cards, credit lines, and have that you can use for other stuff, which you've already suggested, to make sure that you're getting paid, to make sure you focus on growth. Really brilliant stuff. I really want to drill down on something where you said, we don't underwrite the business owner, we underwrite the business. What do you look for when making a decision of whether or not you're going to lend a business money? What aspects of the business? We already talked about the amount of revenue. It sounds like they need to have, $100,000 to, plus. I think on the minimum side, really be considered for this. But what are you looking for when you're underwriting that business?
Sure. So we actually do have what we call Launchpad, which is a product for those customers with less than 100K in revenue. So, we will work with small customers who, if you've got $7,500 in the last 30 days in revenue, we have a specialized product, kind of one size fits all. It's $2,500. It's a 33% remittance rate. And it's about $375 in fees. So, not low cost capital, but it's the first capital most of these merchants can qualify their business for. And then, the next month we'll do that again, or scale them to 5,000 if their business is growing. And then try to get them on a cycle where then they can use our core product. So, what we're really looking for in terms of the core customer, the 100,000 to 10 million, is how long have they been selling, right? Can we actually look at that sales history, and is it consistent enough that we can build a forecast off of it? And by the way, we have customers that have, up into the right curves that are very consistent. We have other customers that it looks like an EKG chart, right? Going up and down, but you can still see that up into the right trend. And so just because that is their cycle doesn't mean they're not lendable. It just means that there's more volatility in there. And so we just have to adjust kind of what we think the overall repayment rate over 90 days or 150 days would be, with that kind of up and down in their business cycle. And so then what we're doing, right, is building that future forecast, assessing how we think their revenue is going to be, and then offering them capital against that forecasted revenue, and then collecting as that revenue is generated and the deposits arrive. The other thing that we work with is, we've had merchants where, reserve balances were increased by the payment processors, and they didn't get deposits for a few weeks. We don't get paid then. We are aligned with the merchant in that cycle because we know the money's going to come out of that system eventually. It's just friction that exists, and we're aligned with that friction. And so when that money does then get deposited, that's when we then collect. So unlike a credit card that would say, "Hey, look, it's been 30 days, it's time to pay," right? Or if a traditional 12-month loan that would say you've got to pay $5,000 a month. We say, no, there's been no deposit. We can see the sales, so we know the deposits are building. It's trapped in the system, and we'll wait for that system to release it so that we're part of that repayment cycle.
Who can't you help? And what I mean by that, and you can give me some terms on the low end, but like, who are the people that come to you and you're like, dang it, if you wouldn't have done that thing, like we could have helped you. Like, what do you see as a frustration where e-commerce guys are making mistakes out there, and if they wouldn't make those mistakes, they could have got the funding that they needed?
One, guys working with predatory lenders. There are a lot of predatory lenders out there, and those lenders are really built to extract a ton of value for the money they provide, but also if that business has trouble, they're very, very quick to put that business, essentially, if not into bankruptcy, very close, right, trying to get their capital out. And because of that, right, we're just not optimized for that. So, we have to stay away from them. The others would be, they've just taken up their cash advance products. And so they've maximized their working capital line already with other providers. But for those customers, we stay in touch, right? So 90 days from now, they may have actually opened up the position for us. And then what we're going to do is work to win that 100% of that position over time, because we think we're the best optimized and the most fairly priced product for those merchants. I think the other guys are just, those that actually have not yet learned some of the early disciplines around spend management. We see a lot of merchants where they'll have personal expenses in their business accounts. It's not that we won't lend to them, but that is a red flag, right? Because you're not kind of segregating funds. And it's really important to really run your business as a business. We also don't work with sole proprietors. We're very explicit. We work with limited liability companies, limited liability partnerships, C Corps, S Corps, and B Corps. But you have to have established a business entity, either in the state you're operating in, right, or Delaware or something like that. Because what we want to see happen is that the business becomes the entity that is successful. Because of that, right, the founder is also going to become successful, but we don't want to lend to the founder, right? That's what his personal credit cards are for. And he's already using, his personal or her personal borrowing capacity, right? And you mentioned it earlier. If you take money from us, your credit cards are still there. And so that credit card, how you spend the credit card dollars can be redeployed to other facets of your business. And that's what we expect the merchants to do, right? Is to take the broad range of tools, but redeploy capital in other areas where their willingness to take personal risk has been priced by the credit card, by the issuer. And they can then take that risk to further grow their business. And we'll continue to take that lower risk position on the inventory turnover. And then the beautiful thing about our model, right, is because we're turning over 45 to 150 days, as those sales are accelerating, 2 months from now, your borrowing capacity is going to have grown. And we're going to then lend against that, because what we're trying to do is make sure that you can continue to grow and that your growth doesn't outpace the dollars you have necessary to keep inventory in, to keep cycling it through.
Eric, it's been an honor having you on today. We help a lot of business owners get capital. I'm glad we found each other, because I don't know about what you guys do. And I can just think of so many people in my head that come through our doors that you guys are be able to help. So hats off to what you built. I love what you guys are doing. Where can everybody go here? If I'm watching this, if I'm listening to this, I'm like, man, I want to launch an e-commerce business. I already have one. I need to get capital. This really speaks to me. Where can they go to be able to talk more and try to kind of start the process of getting approved?
Yeah, come visit us at onrampfunds.com. Our phone number is on every page of the website. We have a team here that'll take your call, walk you through our process. Um, you can sign up online if a lot of e-commerce merchants don't have time to get on the phone. So most of this can be done without any kind of phone call at all. And connect your store, and we'll start putting together offers for you, and then help make sure that you have the capital you need to grow the business.
Eric, thanks for coming on.
Thank you so much for having me. I really appreciate it.
All right. So listen, if you're listening, watching this, you're thinking about getting into e-commerce, you already are, you need to get with these guys, period. What you'll hear from me if you listen to live streams, et cetera, in the future is I will refer to this interview and this product as one of my favorite products in 2022. And I don't mean the exaggeration. I mean, I've asked all the questions that need to be asked to know how solid is this product and who can really help. And this is phenomenal. I mean, from being able to help people newer into the e-commerce industry to people that are very well established, to help you overcome inflation, to help you overcome supply chain issues and all the real problems that you're facing right now, to solve the biggest problem that anybody in e-commerce faces of this gap between when you actually need to pay for inventory and when you can actually sell it. All of these problems being solved, and then you're almost getting like a consultant, a coach. It's almost like something you'd only get if you really sold large swaths of equity in your company, right? If you sold large swaths of equity, you'd get that advising piece that their software provides, and then you'd get the capital, but then you would own the company, right? They're giving you all of that stuff at one of the lowest fees I've seen for the risk of client they've helped. And a lot of things he said along the way that are brilliant. Don't be a sole proprietor. We talk about this all the time. Getting capital out of order, right? You're going to get expensive merchant cash advances when you have a substantially more affordable, sustainable option here that you don't have to pay for that expensive money. So all you need to do is go to onrampfunds.com. Go to onrampfunds.com. Their site is super simple to navigate. I mean, you just hit a button and just fill out some information and you're well on your way. And there's a lot of other details that you're able to get right there as well. So make sure you visit onrampfunds.com, onrampfunds.com. You're here like pre-viral to find a product before this thing becomes so blown up. It could become more expensive. I don't know. But all I'm saying is that now's the time to get this thing started, because so far of the hundreds of people that I talked to with new products this year, this is the best I've seen. This is phenomenal. So make sure you go to onrampfunds.com, get started, and grab this to solve the biggest problems that you're going to face financially in your e-commerce business. Thanks for tuning in.